Okay, guys, welcome back. This is the Movement Experience. I'm your host, Merrick, and today, episode 10, I got a special guest with me, my friend Brandon Regier, mortgage aficionado, mortgage professional. So I figured I'd bring him on, and we'd talk everything under the sun about mortgages and whatever else our little heart's content gets us into.
Sounds good.
So Brandon, introduce yourself. Who are you?
Brandon Regier, principal broker, Lennet Mortgage Group. I guess I shouldn't look at the camera.
You can if you want to.
Oh, okay.
Stare away, baby. let everyone know what you bring to the table. It's smolder, not just mortgages.
Yeah.
So how long have you been doing mortgages?
Yeah, I've been doing mortgages for just about a decade, actually.
Wow, really? That long?
Yeah.
That's crazy, man. Time goes by.
Yeah, I know. It's crazy.
So tell me, when you got in, I mean, your kids are young. You have two boys.
Yeah, two boys.
They're younger.
6 and 7.
So they weren't even around?
No. Well, no. So, yeah, I have a bit of a background. I guess it didn't go directly straight into mortgages.
Okay.
Graduated with my commerce degree from Sauder and started working for one of the big banks. And
you want to say which one? Does it matter?
Well, then if I speak ill of them later, it might come back.
Well, let's not speak ill of them. Don't tell me who it is, because I want the ill speak later. So we'll just say one of the big five.
Yeah, one of the big five banks. They hired me in a kind of a beginner position, which I thought was a little offensive.
Okay.
When I started, just because I spent all this money and time getting a fancy degree, But once I started there, I realized, you know what, I got to learn this stuff. I got to learn the systems. I got to learn the industry, and that starting position was great experience. And right away, I think it was about 2 months after I started with them, we had a senior financial advisor in our branch that was the kind of part of the high value segment. I said, well, this is what I want to be doing, right? I don't want to deal with, everyday average Joe walking off the street. I want to have my own clients.
Build a book.
Build a book. So, 2 months in, I went and met with the manager of that division, and, we started chit-chatting and had coffee, and then I realized, what? This guy's spitting out all these acronyms that I don't even know yet. Right. So that allowed me to step back a bit and say, maybe I need to learn this a bit more, right? Get comfortable with the industry, and then work my way into that position. So I did that, and within a year, I was able to start my own book. And
for the people listening that don't know, what is a book?
Yeah. So a book is just, a book of clients, like a list of clients that you take on.
Your portfolio of clients.
Your portfolio, and you manage. In this particular position, it's kind of like a lower level private banker.
Yep.
So you do everything for those clients. You manage their day-to-day stuff. You do all their investment planning, retirement planning, and then you do their credit.
Are you working with like businesses at all, or are you just working with individuals?
I was
like, would you handle the RSPs for a business or something like that?
Well, I was on the personal side, so
okay.
It was more personal investments, personal assets that we would manage, and personal credit.
Right.
And then anything else that was business, we would send to a business advisor.
Okay.
But there was the odd little business thing we would look after. So within about 3 years, I was on that. I had a portfolio. I started from zero. I grew it to about 80 million. And then I realized, I used to sit there in my office, and I loved my job, loved it. There was a lot of negativity around the investment side.
How so?
Just dealing with the markets.
Right? Oh, like you were getting flack on that side?
Just dealing with putting out fires.
Sure.
A lot of people don't understand investing. A lot of people don't understand investments.
Yep.
The investments that they're in properly. And
as long as it's always going up all the time, they're happy.
Yeah, for sure. Of course. Who wouldn't be?
Yeah.
Who wouldn't be?
Yeah.
But obviously there's pretty serious events that occur that affect our markets.
Right.
And there's nothing you can do about it.
Right.
So as an advisor, you're always sitting there, explaining everything. And realistically, I wasn't a stockbroker.
Right.
I wasn't trading individual securities. So, you're putting these clients into managed portfolios.
Right.
Where in a managed portfolio, I'm not looking after the day-to-day investing.
Right.
You find a suitable class or risk level that they're going to be investing in, and you're supposed to stay in it long term, ride out the waves.
Right. And you're not in the driver's seat. You're putting them into this vehicle. Someone else is managing it, selling, buying.
You got professionals that do the nitty gritty every day. You got massive companies managing these portfolios.
Right.
And I used to sit there, and then I started doing the credit for people. Mm-hmm. And I always enjoyed the credit. And then I started to kind of, do it for family and friends. I'd write, my family's mortgages or our friends' mortgages. And I used to sit there and be like, oh, you know what? It'd be nice to just write mortgages all day.
Right.
Right. Like, how nice would it be just to do this all day, not have to worry about maintaining, dealing with clients calling you every day for the same issue.
Yeah. You're talking 10 conversations about the same event to 10 different clients.
Yeah, exactly. Yeah. And it was a lot less positive, right? So when the markets were not doing so well,
right,
you're getting a lot of slack.
They're killing the messenger.
Right. Exactly.
Right.
So yeah, there was a turning point where it was like, you know what? I want to do this. I just want to do just credit all day.
Right.
And then that was kind of the turning point where I ended up leaving the bank and starting my own business.
Right.
Which was, one of the best decisions I've ever made.
In the transition, was there a bit of jumping from the pan into the fire? Was it kind of like, did you land on your feet pretty well?
I thought I did pretty good. Yeah. I mean, I had built a bit of trust and experience through my position at the bank, which helped. Sure. That helped immensely.
Yep.
And I knew credit already.
Right. And when you say credit, you're talking mortgages as a whole.
Yeah, just credit in general, like how to lend money.
Sure.
Right. Like what, you get your 5 C's, credit, character. What? Yeah, I don't even.
Carrot.
I honestly don't even remember.
There's 5
exactly the textbook.
Somebody online is Googling this right now as they're driving. Put your phone down and listen.
Yeah. That's pretty bad that I drew a blank there. But,
that's all right.
I mean, if I thought about it here, I'd get it. But
don't worry about it.
So you just learning, qualifying ratios, all that stuff. What these lenders are. Well, in that circumstance, it was one lender, but what that lender was looking for, what policies they have in place, and how you have to abide by those policies to make a deal work.
Right.
So jumping through the transition, it was more so, okay, now I'm on my own with no salary. Like when I was at the bank, I had a salary.
I made that transition. I know what that feels like.
Yeah.
And you had, at the time, your wife wasn't working, or she was working?
She was working.
You were the main income in the household, though.
Yeah. And I think she was working.
At the time, you had 2 kids.
Yeah, she must have been off.
Right.
Because of the kids.
Right.
Because we had them back to back. I only gave her a 3-month break.
Wow, so, good for you.
Yeah. Ripped the Band-Aid off.
Literally.
Yeah.
Well, at least they're close. They'll grow up.
Yeah,
they'll grow up like best friends.
It's exactly the way we planned it. So
it
worked out perfect.
But you switched into running your own business, I think roughly around the time that your kids were very young. She's at home with the kids.
Yeah, they were very young. Yeah.
It was on you.
It was, and it was chaotic because they were, I was working from home.
Right.
All of a sudden.
Super easy to do that with babies.
You got these kids screaming at you.
Yeah.
And
they don't understand that you're working or on a call. You're just dad's home.
No, they would come into my office. I got so many videos. It's hilarious. They would come in, and especially when they start screaming.
Right.
And we got into a thing with you and Michaela actually about the noise canceling headphones.
Oh, right. That's right.
And
made a big difference.
I had got this one headset that I thought was great. Right.
Mm-hmm.
I would ask people, "Oh, can you hear?" I'd start, go take a leak and say, "Oh, can you hear me peeing?" That was usually my good indicator. If
that's
worked,
a great
and they go,
threshold.
No. Like, oh, great.
Yeah.
Right. You can go. You got to pee real bad. You can pee while you're talking to somebody. They don't know. So my one kid came in and snapped my headset.
Yeah.
One day, and I go back on or the same one.
Right.
On Amazon, but it was updated and it was no longer the same quality headset.
No.
And so, then I started ordering all these other ones. I ordered another one.
Is there a story there where you figured it out the hard way that it was?
Well, yeah. So I actually wanted to not have this silly thing on my head, kind of like we got on now with the big earpiece, which is what I initially had.
You're flying a plane.
Yeah. And so I got the little one that loops over your ear, and I thought it was totally fine. And then I was on the phone with somebody, and my kids are screaming in the kitchen.
Right.
And they're like, "Ooh, is everything okay in there?" I'm like, "You can hear that?" And I had been on, this had been like 2 months later. So I'm thinking back to all these conversations I had with clients, and my kids are screaming in the background.
That is so
and I'm
funny.
like, ooh, that is not good.
Yeah.
Because that's not professional.
For sure not.
Not professional.
But what are you going to do? I mean, honestly, it makes you relatable.
Well, I could have got an office outside the house for sure.
I guess. Makes you relatable though. You're a dad.
Yeah. And to me, it was fun being home. Like I enjoyed being home.
A lot more flexibility too. If the kids are sleeping or something, Chantel needs to run to the store. You're still there. You're working.
Yeah,
but
exactly.
She had freedom.
Yeah. And I have 6 or 7 meals a day. It's quite convenient to just take a couple steps to my kitchen.
Are you still eating 6 or 7
No,
meals?
I think I'm back down to 5.
That's when you were training.
I was, yeah. Right. I was pretty up there for sure. But, wow. Actually,
and just to be for the record, a meal was not a handful of almonds; it was meals.
Well, now it is. Now it's like a protein shake and a handful of walnuts or cashews or something. But back then it was like massive plates, for sure. So
7 times.
7 times a day. Yeah.
Sick.
It was outrageous.
What a chore, eh?
Yeah. So I think we went a bit of a tangent there with that, but the transition ended up being quite good. Right. And
you haven't looked back, obviously. You've loved it.
Never looked back, loved it. And the way the pay structure was with the bank is you'd get a salary, and I had to fight tooth and nail every year to get a higher salary, and then I'd get a variable compensation, kind of like a commission.
Sure.
That would be only paid once a year.
Right.
So you're used to living on a certain level of income anyways, and then your bonus was your bonus.
Right.
Right. So that was financially the transition was pretty seamless, because all of a sudden I started making way more money relatively quickly, like within. But
you're still used to living on a smaller amount, so you're able to put it away and had a flow of stuff right away.
It was really a pretty smooth overall transition, I would say. Yeah. For going from, I mean, there was obviously a gap, a few months or whatever, but we had some savings and stuff like that. So I always recommend, if someone's going to be transitioning, going self-employed, taking this leap of faith in themselves, ensure that they have, 30, 40 grand saved up so that they don't.
3 to 6 months or whatever they say.
Technically, 3 to 6 months is what you should have tucked away. That's when you're working even.
Right.
So if you're going out and starting your own business, you should have even more of that.
Right. So you're saying 9 months, 12 months? What do you think?
Yeah, I mean, I would just, it depends on your lifestyle. For sure. 6+ for sure.
Right. Okay.
Right.
So I'm going to grill you a couple questions.
Okay.
I want to know, so obviously I'm in real estate. I know the difference between a mortgage broker and going to the bank.
Yeah.
But the average person, they're going to walk into the bank, and whatever the bank tells them, that's what they're going to get, because we've been conditioned growing up that the bank is your friend, and that whatever they tell you is the truth, and they have no ulterior motives. They're not making money off your money. Crazy they are. You know what I mean? So tell me the differences. What's a mortgage broker going to do for somebody versus what the bank's going to do? And I want to know the cons as well.
Yes.
What's the advantage of a bank as well? So I want you to give me both. So give me the good and the bad for mortgage brokers.
For sure. So given that I started my career going back, working for one of the big banks, I was able to see firsthand, the hiring process within those banks and the individuals they put in positions to tell people what to do with their money and to advise people, right? So, you saw people being, had a job at McDonald's, and that's considered good work experience for a bank, which was interesting to me.
You're flipping burgers and now you're investing into mutual funds.
Yeah. So the people that they would hire for, the majority of the majority of clients are going to see, the client facing people that you see when you walk into a bank, a lot of them, and not all of them, there's some very good employees, obviously, at certain institutions, but the majority of them would be hired with very little experience in that industry and have not even the ability to save on their own. Right. And have no real knowledge outside of that current position that they went through a couple month training program or whatever.
Right. And then you're taking their advice.
And then you got people going in there wanting advice, and they're getting advice from this person that doesn't even know how to put on their left shoe. Right. And
financially speaking. Well, I'm going to start walking into banks and looking for people wearing only right shoes. Like you're one of the people Brandon told me about.
Yeah. And it was crazy because when I started working in the high value segment, we were on the second floor. Mm-hmm. So when I would go downstairs, these times I'd go downstairs and I wouldn't even know half the people that are there. because it was such a revolving door. I always went in early.
Right.
So I wouldn't see everybody necessarily in the morning, but a lot of times so many people would get hired and quit constantly. They would barely even fully understand their position, and they're already leaving, and then they're hiring new people.
Right.
So the big issue with the major financial institutions is a lot of times they're underpaying people, so they're not going to be able to hire quality people.
They're not getting the cream of the crop.
Yeah, because they're trying to pay them as little as possible.
Sure.
So you have these people who have no license. Well, a lot of them have to get like their mutual fund license, like basic, super easy exam that you can write in a couple days. That's pretty much what they'd have for the investment side, and then have basic training for credit and stuff like that. So when you're hiring that kind of level of people to be kind of the main face of these businesses, people walk in expecting to get proper advice, and they'll get completely inaccurate information. Right. And so I get this all the time. I get a lot of business from banks. And when I say from banks, they're not giving me business. They're indirectly giving me business.
Yeah. They're leaving them and they're coming to you.
They're leaving the banks because they got such poor advice.
Yeah.
Or they weren't able to do what they said they could do.
Right.
And then they come, through whatever.
Through the grapevine.
Network to get to me. And I fully understand it.
Yeah.
Right. So these individuals that are working, and again, not everybody, but some individuals don't have the experience or the knowledge to give proper advice. And this would happen when I was even at the bank. I would get a client sent to me from my manager being like, oh, this client's really mad because so-and-so said they couldn't, they were too old to get a mortgage. Right. And I'm like, nobody's too old to get a mortgage. That doesn't exist.
You can get a mortgage at any age.
Yeah,
you just got to have income.
Well, you just got to have the income to support it.
Right.
And if you die, that house is not going to just sit there.
Right.
It's going to get sold, and the debt's going to get paid back.
Right. I guess it wouldn't matter because 30-year-olds die, 40-year-olds die. So that's kind of an arbitrary point.
And usually the older people are pensioned, so the income is way more secure than you and I's income.
Right. For sure.
Right.
Yeah.
So, and as long as there's equity there, I mean, the banks can get paid back. Right.
Yeah.
So with bank representatives, they don't have an actual license to write credit. Like there's no licensing for that.
Right.
So they don't really have to go through any strict, educational side to kind of starting in that.
They're flipping burgers one week, and the next week they're like, yeah, we can get you a mortgage.
Yeah, exactly. So whereas mortgage brokers, we have to actually have a license, and we have to uphold that license.
Right.
And it's a lot more strict too, right? So our compliance is more strict. And we have not only the big differential is we have not only just one lender, we have, potentially hundreds of lenders.
Right.
Right. So,
and not just the big banks, which you can use as well, but you guys can do B, C, all the different stuff.
Yeah, for sure. And for my personal book of business, I deal with a lot of self-employed people who, have their own businesses that, have a lot of expenses that may or may not be tied to the business.
Right.
Right. And they actually generate a lot of income, or they have creative accountants and they're, paying themselves dividends or doing shareholder loans to buy other properties and stuff like that. Like
which I recommend. If there's loopholes in the system that you can take advantage of and save money on
100%.
That's your duty.
100%.
It's not even like you're right. It's like you need to do that.
Yeah. And because you don't think the wealthiest of the wealthiest are doing it. They're doing it.
They're paying less taxes than the average.
Some of these guys are paying millions of dollars to their accountants just to save tens of millions of dollars, right?
Of course.
So there's obviously systems in place. So where was I going with that?
Well, we're talking about the difference in between big banks versus mortgage brokers for getting mortgages.
Yeah. So going back to my personal book, like I deal with all these self-employed individuals, and they can't get conventional financing a lot of times with your big banks.
So just to clarify for those in radio land, conventional financing is like an A-type mortgage.
Yeah. And I mean, conventional in mortgage terms typically just means, not a high ratio. So you have more than 20% down, but but in the terms I was referring to was, like a standard mortgage, that would fit the guidelines of your major A lenders or your big banks or credit unions and things like that.
Right.
Ones that are more conservative.
And that's an A.
So we break it down into 3 buckets, A, B, and C.
Yep.
Right. So A is your big banks, credit unions. We have a lot of monoline lenders, which are lenders who just lend money. We call them monoline lenders.
Okay.
Those are all in the A category. So they're going to be very strict on qualifying ratios.
Sure.
You're going to have to fit certain parameters for credit and income. Everything's kind of above board. Then we go into the B category where it's, you have clients who, like we were mentioning, that are self-employed and
showing less income on paper.
Showing less income on paper,
down,
right? There's guys that made, $4 million gross revenue through their business, but they claim, $60,000 in dividends that year. The bank's not going to lend you nothing. Like they're going to lend you $200,000. Right. Well, especially with today's interest rates.
Right.
So how do we get around that is we look at our alternative lenders or our B lenders who actually look at what income they're actually generating through their bank statements.
Right. They're looking at the whole picture.
They look at the whole picture. And it's usually like more of a stated program. So we do a lot of that. Because you can tell when clients are good clients, right? If a client owns 5 properties and has $300,000 in cash in the bank,
right,
and he's got $1 million in RSPs or whatever,
but he's got 60 grand
of income. Like he's good for it, right? He's probably good for it.
Yeah.
Whereas the banks will look at a first time buyer that has been working a salary job making $50,000 a year. Have never really owned anything, and that's better to them,
right?
Which is,
it's wild.
It's interesting for sure.
It's a good way to put it, I guess. Interesting. It causes my interest. Yeah.
Yeah. So a lot of the big banks don't like that self-employed. Like everyone fits different buckets, right? It's not very uniform, so you can't just say everyone's the same, and that's why you have to be skilled and have enough knowledge of the industry and of the different lenders and different options to really be able to advise your clients properly.
Right.
And that comes with experience, right? So a lot of people, if they don't have experience, even new brokers, they really struggle because all of a sudden there's so many options. And like I came from a bank with one policy. You got one set of policies, that policy inside and out, piece of cake.
Right.
Right? Piece of cake. If you do it for long enough, you'll know it inside and out.
Right.
Right? A lot of the bank representatives, like I said, there's high turnover. So, they're not even getting the experience. They're not even getting to know that one policy. So then when you go to be a broker, now all of a sudden you got 100 policies.
Right.
And now you got to know these policies inside and out.
Right.
And a lot of people don't quite get there. Right. So that takes years and years of experience. And some people learn and retain things faster than others. Right. So
yeah, I know that's true.
So it's a bit of it's a big difference, but it's a huge competitive advantage being a broker because you have those other options. Whereas the banks, you get sent a file. If it doesn't fit the parameters of that specific bank,
not approved.
Right. Some of them, the odd ones, will have like a B channel that they can refer to.
Sure.
But it's not hands-on. They send it to somebody else.
Yeah.
They can't actually do it themselves. And they lose that kind of credibility with that client or that relationship with that client potentially, right?
Right.
So
this is when your phone rings.
Yeah, 100%. 100%. And then the C category is your private financing.
Right.
Which I do quite a bit of private financing as well. So
and why would someone need private financing?
Usually it's short term, right? Like typically someone gets into private financing for a short term.
6 months, a year.
Exactly. Yeah, we typically write just 1 year terms.
Okay.
And they usually get broken early. Sometimes they don't. Various reasons.
This is like would like bridge financing fall into this? Like if someone's buying but they got to sell first, or
bridge financing you can typically do with your big bank or normal lender as long as you have 2 firm contracts.
Yep.
So you have to have a firm contract on the sale and the purchase to be able to do proper bridge financing.
Okay.
So if you don't, you could do theoretically bridge financing using equity on your existing property to purchase the other property.
Yep.
That's in the case where you're 100% financing your new property for a short period of time.
Right.
So that's something you would use private lenders for. Some people move. I got a guy coming from Mexico moving back to Canada, and he needs funds, but he's got no employment record.
Sure.
right? So the only way he's going to get money
do you get an employment record from the cartels or? JK.
Unfortunately not.
Yeah, no. Dodgy at best, unfortunately.
Yeah, and there's a lot of things like even construction's a common thing. Banks won't finance properties mid-construction.
Right.
So guys run out of money.
Right.
And they're mid-construction.
Yeah, then they're screwed.
Banks aren't picking it up. So you got to privately finance that and hope you got enough equity.
Wow.
Yeah.
Yeah, I mean, and then honestly, you're doing them a service. Otherwise, they're not going to get it finished.
So they'll get it finished. Yeah.
Yeah. Someone's going to come in cents on the dollar. Yeah. Take that away from them.
Yeah.
And that person's just.
So that's a common thing. But nowadays, people building usually should be pretty dialed in with their finances. But sometimes they kind of get caught in a bind and they need funds for something else.
Sure.
Right. Usually
life happens.
Yeah. Or they're investing elsewhere and they think, borrowing at 12% is a better move than foregoing an investment. Right. So.
Wow. It's a good investment.
Yeah. Well, there's a lot of good investments out there.
For sure.
But there's also a lot of bad investments. So.
All right. So, I mean, obviously there's the advantage of experience, knowledge, multiple vehicles instead of just one vehicle.
Yeah.
What would be an advantage of a bank? If you had, I want to play devil's advocate here. What would you say an advantage of a bank would be over a broker?
So the banks can do different things. So like obviously we deal as brokers with banks. We don't deal with all banks.
Okay.
So there are a few banks that we can't deal with because they don't have a broker channel. Okay. So, if you work for that particular bank and they have good policies, they have good programs, then that's an advantage.
Sure.
Right?
If the client fits into the parameters that they have.
Exactly.
Okay.
Exactly. And if they don't, then you're kind of hooped, right?
Then you're back to square one again.
Exactly. But the branch will offer different types of level of servicing that we as brokers can't do. So a lot of times, like if you have an existing mortgage with TD, for example, we do business with TD. Right. If someone sells their house and wants to port that mortgage to a new property and they're not adding any funds, that's a service. It's you're qualifying for a whole new mortgage. You're having to go through the whole process. But since there's no additional funds, they send those deals to the branch.
Oh, okay.
Right. So then the branch has to service that. So from a servicing standpoint, as brokers, we can't do a whole lot with certain lenders. That's mainly the big banks. Sure. And credit unions. Right. Our other lenders, like our monoline lenders, they will let us service because they are predominantly only through brokers, really. Right. So from a servicing standpoint, the banks are going to be better long term in terms of servicing that mortgage. Sure. But a lot of times people don't do a ton of servicing anyways. Right. And
so it's in the one-off instances and stuff like that.
But more so, there's a couple lenders, a couple big banks that have good programs that the other big banks don't have. Mm-hmm. That's kind of their main competitive advantage. And then they also can kind of run things up the chain a little bit more direct through their management, which may help their case. Right. In more unique scenarios. Right. So, okay. That's probably about it.
Pretty fair answer, I think.
Yeah.
Pretty fair answer. So if you could give yourself advice getting into mortgage broking, so let's say somebody's just getting into it, you're turning back, you're looking at little Brandon, he's there with the stars in his eyes, just getting into mortgage broking. What advice would you give him?
Call everybody you know.
No doubt.
Bug the shit out of everybody.
That's the same advice I give to new realtors, isn't it?
Yeah.
Call everyone you know.
When I started, I told everybody what I was doing. I would talk to somebody for a couple minutes, run into somebody somewhere, tell them what you're doing. Yeah. Don't be afraid to put it out there.
Don't be a secret agent.
No.
Don't be a secret
agent. Put it out there.
100%.
And I kind of remember that now because I don't do that as much.
Yeah.
And I got a little too comfortable.
Yeah.
So... But I do think about that, and then I got to start telling people more too.
Yeah, and if you believe in yourself, like you talked about your experience and stuff like that, what you bring to the table as far as giving people the best vehicle for them financially, you owe it to everyone you talk to talk to them. Yeah, because you're going to give them, that you're going to give them good service. Yeah, so you literally owe them. You're actually giving them a disservice if you don't talk to them, and they go somewhere else and get bad advice.
Great point.
And I think about it all the time because I'll be like, I don't want to be on. Yeah. You know what I mean? And that's part of our job is where we have to be on. So I go, no, I'm a good negotiator. I'm good at reading contracts, catching things when I walk through a house or whatever. Like it's my job to make sure that people are getting the most adequate service that they can get. For you, it's the same thing.
Yeah, for sure. It's just a bit tougher when you're new. If you're talking to little Brandon and giving him advice. It is tough when you initially start because you don't know everything.
Right.
So you're not.
But you do have mentors, people up the chain.
When I started, I didn't really lean on anybody. I'm kind of
But you had such a background.
I did have a bit of that background, so I already knew. But I already knew kind of the basics.
Yeah. What about little Johnny, who doesn't have a background, just got his mortgage license?
Johnny, yeah, you gotta have someone in your corner, right?
Okay.
That's the big thing. So like when I hire new brokers, I want to give them all my knowledge. Anytime they call me or ask me questions, I'm going to give them everything I know.
For sure.
Because why wouldn't you?
Yeah. And I'm sure is there liability too if you don't?
Well, your liability is them just saying, see you later.
Yeah, you did what?
Yeah.
See ya. So the advice you'd give them, call everybody you know, and just...
Yeah, and just hustle. Just work.
Yeah.
Just work.
That's kind of a tough these days.
But love what you do too, right? If you don't love what you're doing, it's gonna be tough.
Yeah,
it's gonna be real tough.
Yeah,
and if you don't have a knack for that certain industry or that certain job, don't try and force it.
It's funny. I heard someone, they said chasing your passions is bullshit, and I was like, what? That's the opposite of what I've heard my whole life. And it's like, he's like, what you do is you find something that you're pretty good at, and you put a lot of work into it and get really good at it. And then you're going to get passionate about it because you're good at it. And then that's chasing your passions.
Potentially.
You know what I mean? I was like, that's a good way to look at it. Cause it's like, if you're good at something and you're passionate, like you become more passionate about it as you evolve and get better and better.
I could reference my hockey career though.
What do you mean? Let's reference away.
Cause I got quite good.
Right.
And I got to, a level where I wanted to be at. And I still didn't have that passion.
Interesting.
That passion never came. It took 16 years of playing, and it never. Well, I guess it wouldn't have been that long. I guess it was probably 12
were
16-ish
when you quit.
Yeah. So that passion never came.
And for those that don't know, I'm going to toot your horn because you're not going to toot your own horn, but you were like one of the best players in Western Canada.
You were up there for sure.
Were up there.
I was a first round draft pick.
First round draft pick for the Dub
for my age group.
Right.
Yeah.
And you played as a 15-year-old. You had exemption to play.
Well, you're only allowed to play 5 games as a 15-year-old.
Right. And then you'll wait the next year. Then, 16, 17 you start.
Yeah, then I was supposed to go back to Brandon, Manitoba the next year.
Brandon, Manitoba.
And hung it up. Yeah.
Absolutely fitting. It was in the stars.
It was good.
They named a city after you, and you didn't even want to play for their team.
Well, I told every other scout I didn't want to get drafted. So the only 2 guys, when my coach told me to do it for bragging rights, and I said, that's a good idea. So the next 2 guys that called me was Brandon Wheat Kings and I don't know, I think it was Swift Current or something like that. Sure. I said, yeah, for sure. And sure enough, Brandon picked me first round. So
interesting.
I feel bad about it.
Well, it is what it is.
It is what it is. Most of those guys.
Brandon, Manitoba has never financially recovered from that decision. They're still not doing good.
Oh yeah, those two pro stock twigs really did in that they gave me.
So you never had a passion for it. Never bubbled up and came.
Well, I always
you enjoyed it.
Yeah, enjoyed certain aspects of it.
Sure.
But it wasn't. I wasn't out there practicing every single day.
Yeah, you weren't building your life around it. I know. I see some kids and they're literally in the yard by themselves, 10,000 pucks, and they're shooting and shooting.
Well, and I even watch my one son. My older boy, he's very passionate about being a goalie. Mm-hmm. Very passionate. He sleeps with his goalie helmet.
I saw when you got him a new one. You posted on Instagram, and he's got his he's the biggest grin I've ever seen him have. Yeah, he's ear to ear, and he's got his helmet on.
He's fired up. And then my younger boy, he's more like me, pretty nonchalant. About it, right?
Yeah.
But anyways, enough about.
Yeah, enough about hockey. I got a question for you. Let's get back to mortgages. So there's, I guess it was in January, Canada posted 2.9% inflation.
Yeah.
I want to talk about inflation.
Okay.
I want to talk about the Bank of Canada, how inflation affects the Bank of Canada's rates, why it does.
Yeah.
And I kind of want to ask about the difference between the Bank of Canada rates and then what are we actually getting, at the kiosk, so to speak.
Yeah.
So let's talk about first inflation rate.
Yeah. So inflation, we saw tick down to 2.9%.
Yeah. Does that matter? Why are we watching that? Why does that matter?
Well, we all know life's very expensive right now.
Yeah. 2.9, more like 50%. I mean, everything is so expensive these days.
Yeah. And inflation was so low, inflation was getting so high, they had to start moving rates around. Right.
So why do they move the rates up to curb inflation? How does that help?
Because it's more costly for businesses and consumers or individuals to borrow money which a lot of our economy is, run on essentially.
Based on,
especially businesses, right? So businesses, they borrow money to, buy inventory or run their business,
expand,
operate, whatever it may be. So if they increase interest rates, that's going to increase their overhead, their costs, and that's going to get passed on to consumers. And then people are supposed to kind of stop spending more money.
Right.
Right. And
so then, raising rates, the idea is to curb spending, frivolous spending.
So individuals from, like you and I who have mortgages, now all of a sudden our cost of borrowing is significantly higher.
Right.
Now we have less disposable income.
Right.
So now we're going to spend less in the economy.
Right.
And that should, based on supply and demand, less demand is going to reduce that inflationary
there
pressure.
You go. That makes sense.
So there's obviously a million variables, but yeah, so we saw, and we can kind of keep delving into this, but we saw inflation tick down to 2.9. It was previously at 3.4%.
And the target is 3%.
Well, the target's always been 1 to 3%.
Okay.
Right?
So 3 is on the higher side of what they want.
The bank now wants it under 2%.
Oh, perfect.
Right?
Perfect.
But if we strip away
the carbon tax,
the carbon,
it's ridiculous.
Well, the carbon tax is very minor, but
I know.
If we strip away mortgage costs,
that
inflation, that consumer price index is really closer to 2%.
Oh, really?
So you're kind of getting close to that target. So through inflation is our consumer price index, and there's 8 categories.
Yeah.
And one of the big categories is shelter.
Shelter, right?
Right, which accounts for 28% of our consumer price index.
Right.
Right. 7% is rented accommodations.
So when they're jacking the rates up, they're actually jacking that up and
it affects everything. So that it does affect that obviously heavily indirectly, but because there's 7% is rented accommodations, which, and we can delve into some other numbers on what affects the rental market as well, but and then 18% is owned accommodations, and then you got like 3% for fuel and electricity and
tobacco.
Tobacco's another bucket. And actually cannabis is now in that bucket too.
Tobacco, cannabis, and alcohol. The three essentials, the 3 wise men.
Very, very essential.
Right.
So out of that 18% of this consumer price index, one of your main components is mortgage interest costs, right? So that's obviously going to heavily influence our inflation, right?
Yeah.
So by them jacking up interest rates, it automatically increases our inflation.
God, I love the system.
Right? So,
But I mean, that's really the only lever that the bank has.
It's the only thing that they can do with a somewhat immediate remedy, right?
And it does take, I heard it takes up to 18 months to really see everything filter into all levels of
and
the
that's
economy.
why we're seeing things finally start to settle in, right? So now we're seeing things finally taper off. People are starting to cool their jets. But we're having things like, what influences the bank's decision is obviously inflation. With their policy decisions, is their interest rate policy decisions is inflation is the main one, but also employment, right? So we're seeing, we saw in January there was 37,000 new jobs created, which is double the bank's expectations. Then
were those were part-time jobs though, right? A lot of them were part-time jobs.
I don't recall exactly what the split was, but.
Doesn't matter. Jobs were
created. Yeah. And what's even more interesting is we saw last month our adult working population increased by 125,000 just in 1 month.
Wow.
Just in 1 month.
Is it immigrants or is that just like people coming of age?
Well, it's
both.
It's a combination, but and that's what I'll delve into as well is the immigration side. But in the past year, we've seen that adult working population increase by 1 million people.
That's a lot.
1 million people.
Yeah, we don't have a big country. For those of
we
you
don't have a big country.
That's a lot. We're 36 million, 37 million, I think.
That's a lot. We're creeping up pretty fast.
Yeah, I think we're almost 38, but not quite 38.
So we're, if you look at that just in how that's going to affect, we're obviously heavily in the housing market.
Yeah.
Now you have all these people. These people need to live somewhere.
Yeah.
And that's going to affect housing prices, rental market.
Starts are down.
Everything, right?
I mean, everything's so slow, and it's like we have such a low supply.
Yeah.
And we got lots of immigrants coming.
So that's why we've seen rental prices are ridiculous.
Through the roof, man.
But our our carrying costs on properties is outrageous now too. So, to own a property now with 20% down to try and rent it out is impossible. Like you're forking out big bucks.
Right.
Right. You're forking out, you buy a single family home, put 20% down, you're forking out probably $1,500 cash a month to long-term rent that.
Yeah, for someone else to live there.
Right, because it's
and
so
cause damage, and you're maintaining the maintenance and paying the taxes and all that stuff.
And of course, we're not talking about Timbuktu, Saskatchewan. We're talking about, the major hubs of our country.
Yeah, Toronto, Vancouver.
The Greater Vancouver area, Toronto area, Greater Toronto area. They're all, getting driven up like stink because of what's been going on.
Yeah, it's wild. So let's talk about Bank of Canada's rates. And then how does that translate to the rate that's posted in the bank or by the broker that you actually pay in your mortgage?
Yeah. So obviously everyone hears about the Bank of Canada prime rate. That's the big rate that everyone hears about. Everyone assumes that's kind of all rates, which is not true. The Bank of Canada prime rate is what all the major financial institutions lend to their consumers on any kind of variable rate or adjustable rate products. So they're tied to that prime rate.
So is the prime rate the rate that the bank pays to the Bank of Canada?
No. So the rate at which the major financial institutions lend money to each other in the overnight market is called the overnight rate.
Okay.
So that's the rate that they actually adjust, and the prime rate's a spread against that. And then the prime rate's what the financial institutions base their consumer pricing off of.
Okay, so they're not advertising the overnight rate; they're advertising the prime rate. When you see the prime rate,
it depends where you're looking and who's looking, right? Like I look at overnight rate. Some people, most people will just look at prime rate because that's all that really gets passed on to the consumers because that's the consumer-facing rate. Right. So when you go to a bank and you apply for a mortgage or a credit line, it's going to be prime minus X or prime plus X. Right. Right. Okay. So when you're dealing with that prime rate, anything that's tied to that prime rate is obviously variable. It adjusts when the Bank of Canada adjusts that rate. Your interest rate automatically changes, right?
Yeah, there's a lot of people that have experienced that. A lot of people are really getting squeezed.
Massively. I personally even have a mortgage that was at 1.8%. Now it's at 6.65%. Right? And it's like, wow, crazy.
Yeah, I've been, this is sad, but I've been at tables with people that are, at wit's end, divorcing because they can't, they can't deal with it. And, like they're just fighting over everything. And it's like, this is real. This is real shit.
Yeah.
What do you say to somebody that is in that situation? They don't want to move. They love their home. They love their neighborhood. They love their school district. Is there a vehicle for them, maybe with B lending or something like that, where they can maybe just pay interest for a while, like get a line of credit against their house? Like what can we do for these people that are strapped?
Yeah.
You know what I mean?
It's tough. It's tough. A lot of circumstances, there's usually ways of doing things if people have equity.
Sure.
But 9 times out of 10, it's going to put them in a far worse position.
Okay.
Right? So
you're saying hold the line.
If you can hold the line, cut out if you want to stay in your house, maintain that mortgage and that house, you need to cut back elsewhere, really. Right. Because if you go and find an alternative measure for that financing, it's only going to increase your cost of borrowing. Right. So your cost of borrowing is going to increase. Even if your payment is slightly less, right. Long term, you're
shooting yourself in the foot.
You're going backwards. Right. Yeah. So there's not really a viable option. I mean, if you have, if your income is lower now for some reason, and it's going to be higher in the future, then that situation might make sense for you. You might be able to, but
mom's not working, baby's at home, but she'll go back to work.
Yeah. But with the stress test and the way how stringent we are on qualifying people for financing, it's not even possible to use. If you're that strapped where you cannot afford your payment, you're not going to be able to qualify for more anyways, unless you're doing it privately. And then you're,
privately wouldn't be the answer.
Yeah. I mean, you're gonna throw a second mortgage on privately. You're going to pay 12, 13% interest, and you're just going to be eating away at your equity. So, is that the right financial decision? If there's a game plan to get out of that, sure. But if there's not, then no way would I recommend that.
Okay. Well, I mean, yeah, I know people always try to time the market too. Like they'll try to hold on a little bit longer because the market's going to come back, let's say.
Yeah.
But I mean,
if you think, and that's a risk, right? So if you have the risk tolerance to do something like that, then that's your decision, obviously.
Right.
But the reality is people just have to come to terms with, if you're going to be in the Greater Vancouver area, you need to be able to afford to be in the Greater Vancouver area.
I know.
right?
I know people have this this attitude of like, you know, I was born here, it should be better and stuff. And it's like, it's a world-class city. Like
it is. It's a major
it's
hub.
like London, England.
Yeah.
London, England is so ridiculously expensive to live in London, England.
Yeah.
You can't do it.
Yeah.
You just, the average person can't do it. It's all foreign money that lives there. That's what's happening in Toronto. That's what's happening in Vancouver. People are moving. It's a beautiful city.
Yeah.
It's safe. It's clean. People move here from China. They move here from America. They move here from all over the place.
Yeah.
And they want to have a home here.
Yeah.
And that drives price up.
Yeah.
It's funny because, you know, people don't like the two-edged sword.
Yeah.
They want the affordability, but they also love the equity when they're retiring.
Oh, for sure.
And it's hilarious.
For sure.
I'm like, well, you can't have one without the other.
Yeah, because
you know?
if you bought a house 10 years ago for $400,000 and it stayed $400,000, you wouldn't be any better off.
No, exactly. People, baby boomers and stuff like that, the silent generation, stuff like that. You know, I had a client, he's 94, you know, great guy, bought his house in West Vancouver overlooking the ocean for $14,000.
Yeah.
$14,000. It's not worth $14,000 now. You know my point? Like, it's like the appreciation and the retirement of an entire generation in Canadians. Anyone who owns a home is able to retire on the equity of their house because the market has gone so up. That's the benefit.
Yeah.
The cost is now the younger generation trying to get in or maintain the market, and it's tough.
Well, and that's why we're seeing, you know, these multi-generational homes.
100%.
Very common.
So common.
And parents are taking that equity that they have been given through our outrageous markets and handing that down to their children to help them purchase homes. Because, I mean,
it's like 95% of first-time buyers have help from mom and dad. That's like something like the stat I heard.
Yeah, I don't think it's quite that high, but it's high.
It's high.
It's high.
I would say we want to argue it's over 90. It's a lot of people are getting some sort of help from mom and dad.
It's up there.
Yeah,
it's up there for sure.
And this multi-generation thing is so common. People are buying, you know, an acre or two.
Yeah.
You know, renovating the old house, building a second house for mom and dad, or, you know, a coach home or whatever.
Because that cost of dirt is so expensive.
Yeah, and it's honestly like we don't have. People think it's like we've got farmland, ALR land. It's locked in. It's not going to get developed on. You know, you may get you know, a secondary dwelling on it, but it's not going to be a townhouse complex. Mm-hmm. So there's only so much land that we have that we're going to be able to build on the Fraser Valley. Like, we are very locked in. I know Abbotsford is a big amount of land, but it's a lot of it is like 90% is like farmland. It's like we don't have that much. So it's a tough nut to crack.
Yeah, they'll slowly wean that out though.
And if you think about it as a politician, like, people always ask, well, why don't they do this or that? And it's like, as a politician, you're really in the middle because you've got these baby boomers with equity, and then you've got these young people trying to afford stuff. And it's like, if you kill the equity in the baby boomers, you're not getting reelected because they're going to be mad. Yeah. And, you know, there's really nothing that you can do. You know, supply is always the answer, in my opinion. Mm-hmm. More supply, more supply, more supply. But yeah, it's a tough nut. These people are like, you know, these policies that come in that don't do anything, they look like they're trying to make a change. Yeah. But whatever. Yeah. Crazy. We digress. So anyways, there's not a great answer for a mortgage if somebody's in a tight bag.
Yeah. Right? Yeah. And then I don't know if you want to go back to the rate thing.
I do.
We kind of only touched on that a little bit. I wanted to explain that a little bit more.
Explain away.
So we touched base on kind of inflationary pressures. And so when our inflation goes out of control, our Bank of Canada is going to increase that interest rate to help slow the economy.
Right.
So you're going to be directly impacted with those variable rate products. So that's one side of the spectrum. So when you see, you know, most people that see interest rates from lenders will typically see, for the most part, fixed rates. Right. But what the Bank of Canada and their overnight target rate and the prime rate is directly impacting those variable rate products. The fixed rate products actually run on a bit of a different tangent. So that's the fixed rates are actually tied to the government of Canada bond yields. Okay. Right. So it's a completely different.
And how are those doing for those that don't know?
So, well,
segue.
Yeah. So obviously our interest rates, where they are fixed rates, since they're directly tied to the bond market, obviously our bond markets, the yields have gone up. So we see things that affect our bond market, which will then in turn affect our fixed rates. So we'll see a lot of changes throughout the year on the fixed rate side because of what the bond market's doing. And we might not necessarily see any changes with the prime rate or those variable rates. So even though that prime rate and that overnight rate is big in the media and big on, you know, people's perception on interest rates, That is kind of one side to the story.
Right.
The bond market will go up and down for various reasons. For example, it obviously is tied to overall economic conditions. It's tied to the credit risk of our country.
Right.
It's tied to interest rates as well. And it's tied to political risk. So there's all these variables that go into play to affect our bond market. Inflation news, for example, we just had good inflation news.
Right.
Inflation ticked down. That's good news. So what that does is that bond market starts to rally.
Right.
So interest rates and bond prices are inversely related. So if the bond market rallies, prices go up, rates go down. So you'll see those yields start to decrease a bit. So we'll see those fixed rates come down a little bit.
So people are getting bonds because they think that the rates they can lock in now are better than what they're going to be in the future. Is that right?
Like purchasing bonds?
Sure.
Well, the value of the bonds change as well, right? So the interest rates, like if you buy a bond, it has a coupon, but that value of that bond changes as well.
Oh, okay.
Right. So it's a less risky investment.
Yep.
But there's still obviously some risk involved. The values of those bonds.
And a bond, for someone who doesn't know, is a promise for the government to pay you back the amount that you're giving.
Yeah. So a bond is essentially a loan that a company or a government is taking out, essentially. So if you and an investor buy a bond, you're essentially lending that company or that government money, and you're getting a coupon in return, or a certain yield. Right.
A promise that you're going to get your money back with this much more.
Yeah, exactly.
Okay.
Exactly. So they have maturity dates and all that.
Yeah.
So those fixed rates that everyone sees are based on that bond market. So that's based on the bond yields. So they'll change throughout the year. So we've seen the last couple months, those fixed rates come down quite a bit.
Oh, really? Okay.
Right. But prime rate hasn't.
Right.
We haven't seen any changes.
Right.
In the last few months. So we've seen the bond market change.
Yep.
And that's affected our fixed rates. So now, fixed rates before were, a 5-year fix was 6.5%. Now it's down to pretty much 5% now. Oh. Some even under 5%.
Terrible.
Some even under 5%.
It's not terrible.
No.
It's not terrible.
I mean, no one should be expecting 2% interest rates ever again. So
right. And that was the thing too. I was wondering, like, obviously in the field, so I can see realtors and I see mortgage brokers, and they're like, oh, 2.9%. This is great news. Everybody, jump in. Blah blah blah. It's like, how long should we expect the rate to be in the target for the Bank of Canada before we're expecting a rate dip from the prime rate from the Bank of Canada?
Yeah.
I know there's a lot of talk. And again, for everyone in Radioland, we do not have a crystal ball. Don't hold us accountable.
No.
This is just a couple of buddies talking.
But yeah. So
what do you think?
The Bank of Canada wants to hold rates, right? So they want to hold rates as long as possible.
Right.
Right? Because they don't want things getting out of control.
Yeah.
And they're going to have their reason one way or another.
Sure.
Whatever they want to do, they're going to make happen. I don't know if you know Benjamin Tal. You know that
I've heard the name.
He's the chief economist for CIBC.
Yep.
So he's a brilliant guy. What did he say? What does he say? He says, the Bank of Canada will always find a number or statistic to suit their
of course.
Their narrative.
Of course. It's like it's like the cigarette companies in the 60s having scientific evidence proving that cigarettes don't cause cancer.
They're always going to find some number to suit their narrative,
sure.
And that's the reality, right? So they're going to focus on, our job numbers, right? Inflation went down, but our job numbers beat expectations.
Right.
So now they're going to say, whoa, we're not doing anything.
Right.
We got a healthy labor force.
Yeah.
Right.
Yeah.
The other side of that is they keep letting so many people into our country. That's going to affect everything.
100%.
No matter what.
Yeah, I mean, I understand the need for immigration. I'm a son of an immigrant, so I get it. But like at the same time, we don't have places for these people to go. Like actual. Yeah. And I don't mean that metaphorically. I'm talking generally, like actually physically. These people are like, there's people in reports that were living under bridges in Ontario because they had nowhere to go.
Yeah.
That's not acceptable.
Yeah.
You know what I mean? It doesn't make it very attractive on the world stage that we've got immigrants coming to our country looking for a better opportunity and they're living under bridges.
Yeah.
That's wild,
for sure. So something's going to have to give here soon.
For sure.
So with that job report coming out, all of our economists, not all of them, but the majority of them who previously thought that they would start decreasing in April, have now pushed their expectations back to June.
Yeah, that's my gut as well.
Right.
People are expecting, first of all, the next announcement's March 6th.
Yeah.
Nothing's going to happen.
No.
And then it was supposed to be April.
Yeah.
But I think they need to get through the spring market before they even would
because
consider
they don't want to tip things off
No.
and things to go crazy.
No. And you have so many people, like I know from my side in the buying and selling, they're waiting on the sidelines, like just waiting to jump in.
I know.
They're waiting to jump in.
Yeah.
People are still having kids. They're still getting married. They still need more space or less space, getting divorced. These things are happening.
Yeah.
Regardless of, they're wanting to time the market. So
Yeah.
as soon as you see a little sliver of like, oh, rates are coming down in April.
Well, even then,
boom.
pausing was enough for some people, right?
on the market.
Even pausing was enough for a lot of people.
Yeah.
And we've obviously seen a bit of uptick in
We
activity.
have. Yeah.
But another major component too is like people say, well, are they going to decrease? Well, they have to.
Yeah.
They have to. We have the Bank of Canada released statistics that 47% of mortgages are going to be impacted by higher interest rates by the end of this year.
Wow.
That's 47% of all mortgages in Canada.
That's a lot.
And they estimate 65% of all mortgages will be impacted by higher interest rates by the end of 2025. Wow. So that's a massive impact. Yeah. And for people who go from paying 2% or even 3% to paying 5 or 6%,
I know.
is a massive shell shock.
And
right?
I've had the conversations with the people. Like you deal with it too.
Yeah.
But I'm seeing the end results of it, and it's brutal, man.
Yeah. And
Absolutely
there's
brutal.
some people you literally have to say, sorry, there's nothing you can do. You got to sell.
Yeah.
You have to sell. And a lot of times it has to do with marital breakdowns and stuff like that.
And that's honestly the number one thing is money. That's the number one thing couples fight about. It's money.
Oh yeah, I wasn't even meaning that. I was just meaning whatever their reason was. They're breaking up now.
Oh sure.
And now they're down to one income.
Yeah.
Right.
Yeah.
Which I mean, I'm sure you're right. Money is a massive thing.
Yeah.
But
anyways, that's part of it. So it'll be interesting to see what happens. I think you're right. I don't think anything happens until summer, if at all. I do agree with you that they do need to do something. That they will need to bring it down at some point. But the problem is, the more people suspect they're going to bring it down, the longer they have to wait until they can.
I know.
And so it's kind of this like catch-22. Like everyone's like, "Oh, we know you're going to do it." And they're like, "Not yet." You know what I mean? So
yeah. Until the roof really falls off. Though,
that's right.
Right. So if the roof really falls off, then they're just shooting themselves in the foot as well, because then our whole economy stalls.
Well, yeah, and I don't think there's going to be a big, like everyone's like, oh, there's going to be a big collapse and it's going to be, Chicken Little, the sky's falling, blah, blah, blah. And I'm like, I don't think so, man. It's just the supply has always been the issue in Canada. We have such a small supply. Yeah. And even if a few people, let's say 30% of those people have to sell, I don't know that I don't know that would be so much inventory on the market that it would just make a collapse.
No, and especially not where we are, specifically. Yes. I mean, you go to York
Swift Current, you might have an issue.
You go to Yorkton, Saskatchewan, or Swift Current or something like you're different ball game.
100%.
Like, you're collapsing. Like there's still properties in those areas that are on the market for over a year. Right. Yeah. And they're $100,000. Yeah. And they're on the market for over a year. Yeah. Right. Like there's we're these outliers to these major hubs are a completely run on their own tangents there.
Yeah, for sure. Sorry, we're getting somebody at the door here that wants to say hello. Oh, my apologies. Well, that's really what I had for you, buddy. Those are my questions. Yeah, we've been an hour. Can you believe it?
Already? I thought that was 5 minutes.
It was 5 minutes. Well, it's 5 minutes when you're having fun. You know what I mean? 5 minutes with a friend is an hour to the guy commuting. So, I mean, it's good background to understand it a little bit better. I think a lot of people, even when they have mortgages, don't really understand. They're like, well, what's my payment? Yeah. What am I? What's my like? It's a wild word. I mean, you're you're dealing with it daily, but it's funny, man. I deal with people and they're just like, oh yeah, I don't know. Yeah. Well, man, I got to pay a penalty to get out of my mortgage. Yeah, that's wild. Yeah. I didn't know about that. I'm like, yeah, dude.
yeah. People. It's funny how many people sign mortgage contracts and don't want to know anything about it.
Yeah. I know.
Nothing.
I know.
Just
like I had a guy
who's
like $27,000 penalty, something like that. It was a big penalty, and I was like, that's a lot. Yeah. That's a mid-sized car.
Yeah. But people don't realize that a mortgage is a contract. It's a legally binding contract.
Yeah, that's right.
You gotta pay the piper when you're breaking that contract.
And then you know what, man? The bank's really good at writing contracts.
The banks are the best for sure. Yeah, the banks are ridiculous. They have all their posted rates and their discounts and all that jazz to to really hammer you with those penalties on the fixed rates.
Right.
So be careful. Even the variable rates too.
Yeah.
Your 3 months interest penalty might be at the prime rate and not your discounted rate too, or your penalty of an interest rate differential, you essentially paying their remaining difference in interest that the bank has to suffer from lending that money out again. They're actually charging you at their posted rate instead of what you're actually paying.
Right.
Which can
significantly higher.
Like triple or quadruple your actual penalty.
Wow.
So that's why the banks have those posted rates and their discounted rates, because they'll get you.
They'll get you. I've never seen banks don't lose money, man. Good markets, bad markets, they're making money. You know what I mean?
That's why they continually pay 5-6% dividends.
That's why they have the biggest buildings in any downtown area you go visit. It's always the big RBC building,
and they all own each other.
Yeah, that's right. Yeah, it's a great system, man. Kind of feel like we're a bunch of honeybees, making money for the mother queen.
Yeah,
you know what I mean?
Yeah.
Well, that's it, man. You got any questions for me? How you feel?
No, feel fine.
First podcast
ever.
Not bad.
Honored to be on the Joe Mattiazzi experience.
Yeah, that's right. Joe Rogan. He's coming in any minute now.
Oh yeah, you say he's coming after?
Yeah. I promised Brandon that Joe Rogan would be here right after we finish the episode. So we gotta hang up the dial here and get him in here.
Good stuff, man. Well, thanks for having me.
Thanks for coming, buddy. Appreciate it.
Okay.
All right, man.
Cheers.
Ciao.